Hello everyone! Today we start a new topic on open economy. This is the topic where we will cover three main concepts. First of all, international trade, then balance of payments and its components. We will learn what exactly the balance of payments identity is. There will be an equation which you'll need to memorize for your exam. We'll cover the differences between deficits and surpluses on balance of payments, how exactly they occur, why do they arise. And later in a week, we'll cover another group of topics based on the exchange rates. We'll learn what exactly exchange rate is, what are the exchange rate fluctuations, what is appreciation and depreciation of exchange rate compared to revaluation and devaluation. So we'll learn different terms which explain the movements and exchange rates. We will also cover what shifts exchange rates, what moves exchange rates in the forex market, and we will briefly cover the alternative exchange rate regimes which the country can select. So let us cover first of all what exactly international trade is. This concept is rather self-explanatory because people trade and companies trade and countries trade as well. So most countries in the world nowadays are open economies, which means that they're trading with the rest of the world. They trade with their neighbors, they have trading partners abroad, they do not try to produce all goods they require for themselves. They specialize in a particular product, in a particular area, in particular market. They produce a lot of this product because they're good at it, and then they sell it to their neighbors, to their partners, and instead they purchase whatever they need. So countries specialize, which allows the whole world to benefit from trade and improve the standards of living. So international trade is simply buying and selling goods and services from other countries. The purchases of goods and services from abroad is what we call imports. So when we buy something from France, for example, or from America, or when we travel to Europe for holidays, or when we study abroad, this is imports. We buy imported goods and services. This leads to an outflow of currency from the UK. The sale of goods and services to buyers from other countries is what we call exports. When we sell something, we export these products to foreign customers. And this leads to inflow of currency to the UK. That is why international trade has a direct link to exchange rates, because it involves movements of currencies. And when we trade, there will be changes in demand and supply of various currencies in the forex market. So let's have a look at a few examples. We will need to focus on two different flows of goods and currencies. Let's have a look how exactly it works. Let's imagine that our country sells something to Europe. For example, we sell our whiskey, Scottish whiskey, to an Italian hotel. So we supply these goods to Italy. So there will be a movement of goods to abroad. Then Italian hotel needs to pay us for this whiskey they've purchased, and in order to do so they will need to change their currency, euros, into pounds, because pounds is an official currency in the UK. This is how we receive our payments. So their Italian euros will be changed into pounds, and then the payment will be sent to the UK. So our export earnings, which we will receive, will represent a credit on our balance of payments. We'll come back to this a little bit later. In other words, there will be two flows here, flow of goods and flow of payments, flow of money. Next, let's imagine that we purchase something from abroad. For example, we buy oil from Russia. We import oil. So this particular trade will involve a movement of goods from abroad. We import these products and we need to pay for them. And in order to do so, we change our currency, pounds, into Russian rubles. And then we will sell the payment to Russians. And this movement of money will represent export earnings for Russia, but it also implies import expenditure for our country, and this will be recorded as a debit on a balance of payment. And balance of payments will simply represent a selection of all our transactions with the rest of the world. This is how we'll record our transactions. Let's have a look at the exam type question which can be asked based on this information. A country has the following items in its balance of payments: exports of goods 120 million, imports of services 60 million, income flows and current transfers from abroad 80 million, exports of services 50 million, imports of goods 150, income flows and current transfers going abroad, 30 million. So there is a set of transactions which took place during a year, for example. The question is, what is the balance of trade in goods? Stop the video, write down your answer, continue when you are ready. Ready? Let's have a look. The question asks you about balance of trade in goods, which means that we will only need to select transactions which are related to this trade in goods, which will include exports and imports of goods. Exports of goods is 120 million, imports of goods is 150. In other words, we have sold 120 million worth of goods, but we have purchased an amount which is higher. We have purchased an equivalent of 150 millions. In other words, we are running a deficit of 30 million. We have sold less than what we've purchased. In other words, we have earned less than what we've spent. We are running a deficit. We'll need to cover the shortfall between these transactions. And in the next video, we will explain how exactly this happens.